All investors know who Peter Lynch is. Who doesn't? He's one of the greatest investors of all time. In the 1980s, Lynch was but a mere portfolio manager, but when he took over the Fidelity Magellan Mutual Fund in 1977, things started to look great for him. Between 1977 and 1990, he proceeded to turn the $20 million assets of the fund into the largest mutual fund the world has ever seen. This mutual fund superstar has outperformed the market and gained a 29.2% annualized return over 13 years at Fidelity. This is what made him the greatest mutual fund manager of this generation. Lynch achieved all this by following basic investing principles, which we'll discuss later on. Hey, welcome to Stock Market Mate. In today's video, we'll talk about beginner investing tips according to Peter Lynch. Before we get into it, make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Peter Lynch is an investment icon. As a mentor, author, and stock analyst at Fidelity, he sure knows what he's talking about when it comes to giving investment advice. First tip would be, buy what you know. Lynch once said, buy only what you understand, believe in, and intend to stick with, even when others are chasing the next miracle. Now, if you've watched a few of Lynch's speeches and interviews, you might have heard him say this often, buy what you know. Doing this can lead you to great retail stocks. Lynch is well known to be a story investor. He selects each stock based on a well-grounded expectation regarding the firm's potential for growth. These expectations come from the company's story. What is the company's goal? What are their expectations? And so on. The more knowledgeable you are about a certain company, the better you'll grasp its business and competitive environment. This in turn gives you chances of finding a good story that will actually become a reality. This is why Lynch is an advocate in picking companies that one actually knows. In fact, he said that he would rather invest in pantyhose rather than communication satellites, and motel chains rather than fiber optics. However, Lynch says that you shouldn't restrict your investments to just one type of stock. Rather, he emphasizes investments in firms with various reasons for favorable expectations. In general, Lynch prefers small but fast-growing companies that can be bought in a cheap price. Next tip would be always do your homework. While brainstorming business ideas are great, you still need to do in-depth research before making your plans happen. Peter Lynch didn't succeed solely by trusting his gut, but he had rigorous research before making major decisions. With every great idea that he's had, Lynch followed several fundamental values that he believes should be applied when looking for stocks to buy. Let's discuss a few of them. PEG ratio. This ratio of valuation to earnings growth rate should be viewed to see how much expectation is built into the stock. You want to choose companies with strong earnings growth and reasonable valuations. A strong grower with a PEG ratio of 2 or more has that earnings growth already built into the stock price, leaving little room for error. Next would be percentage of sales. If there is a certain product or service that initially interests you to the company, make sure that it has a high enough percentage of sales to be meaningful. A great product that only makes up 5% of sales isn't going to have more than a marginal impact on the company's bottom line. Favor companies with strong cash positions and below average debt-to-equity ratios. Intense cash flows and prudent management of assets creates options for the company in all types of market environments. Peter Lynch's next tip would be, don't try to time the market. Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves, says Lynch. Timing the market demands precision. Any active investor or trader who tried to time the market may have completely sabotaged their performance if they happen to miss out on any of that small handful of days. If you stay invested, you're implicitly buying on down days. If you get too active, you run the risk of buying high and selling low. As a beginner, you must understand the process of how markets fluctuate. Indeed, the goal to buy low and sell high is ideally how you can get major returns, and it can theoretically make you rich. However, the problem lies in the fact that no investor gets their market timing consistently right. In a 2018 study conducted by the International Monetary Fund, 153 recessions were analyzed across 63 countries from 1992 up to 1994. The results showed that only 5 of the recessions were predicted correctly by the economists in the preceding year. You simply can't expect how the market flows. Furthermore, by trying to time the market, you can't determine when to enter or exit. While you wait for the perfect timing, you tend to miss out on buying stocks that offer dividends. In connection to that, you also miss out on the income yield from those stocks that conceptually lowers the buy price. So in the face of those said reasons, Lynch warns beginner investors to not time the market. Next tip would be, market crashes are great opportunities. This might be a tough statement to sell, but hear us out. Market crashes aren't entirely bad. A market crash should trigger the desire to deploy extra cash and reaffirm your commitment to your long-term asset allocation. By reinvesting cash into the market with a much lower price, you get awarded with more shares. Market crashes also provide opportunities to manage your tax liability. Furthermore, stocks will be on sale. Most beginner investors tend to panic and sell their shares on the bottom of a crash and might even give up on the stock market entirely. You can use this as an opportunity to lower your average cost basis by buying the same stocks at cheaper prices. Once the market recovers, you'll have bigger unrealized gains, thanks to a lower cost basis. With this information at hand, remember to not get too nervous when the market crashes. Like seasoned investors, you should get used to riding out the highs and lows of the market, removing the emotion from your investment decision and focusing on a thoughtful, disciplined approach is how you create a wealth strategy. On to the next step, don't be too scared of the market. Peter Lynch once said that the real key to making money in stocks is to not get scared out of them. Holding on to your stocks may be daunting to some, especially to beginner investors. Daily headlines and pundits can trigger your fight-or-flight response. This is why it's essential to know your stock well. Lynch explains that by this: you can stand by your stocks as long as the fundamental story of the company hasn't changed. While the fear of making losses can cause you to be hesitant to execute your strategies, you should remember that waiting longer will create missed opportunities. As an investor, you should develop the ability to bear losses. It's inevitable. In fact, a lot of great investors had their fair share of investment mistakes too. The more you learn and study about the market landscape, the more confident you'll become in investing. This is why you should do your part in studying up about the things you invest in. Another tip would be, time is on your side when you own shares of superior companies. Investing in great businesses can give you a valuable edge. Companies with powerful competitive advantages often grow stronger over time as their weaker rival fades away. In an interview by Peter Lynch, he used Taco Bell and Coca-Cola as good business examples. Back then, Taco Bell had no debts, and Lynch knew that the business had a major growth potential. In addition to this, he also used Coca-Cola as an example. Because the business was of high quality, Lynch knew that it would thrive for years to come. And of course, he predicted this correctly. As you see, businesses can generate bountiful profits for decades, giving you plenty of time to compound your gains. And for the last tip, know what you really want. If you're lucky enough to have been rewarded in life to the degree that I have, there comes a point at which you have to decide whether to become a slave to your net worth by devoting the rest of your life to increase it, or to let what you've accumulated begin to serve you, says Lynch. This iconic investor walked away from the mutual fund industry at the peak of his career. Rather than spend his whole life chasing more money, he used the wealth he created to live a full life. Perhaps that's Lynch's greatest lesson of all. Indeed, you still need to put importance on your well-being and determine what your end goal actually is. Well, that's about it for the classic pearls of wisdom from one of the greatest investors of all time, Peter Lynch. If you enjoyed this video, consider subscribing to our channel for more. Thanks for watching, and we'll see you on the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!